Hey, welcome to another daily money clip. Today, I'm going to be talking about taxes and lending and what you need to know if you plan on getting mortgages, business loans, etc., and also saving on your taxes. Hey, what's happening? This is Jerry over at Wealth DynamX coming to you today with another daily money clip. And I'm excited for today's topic because it's a question I'm getting more and more, and it's not something that's talked about very often. Okay. And this is the topic of qualifying for loans, optimally, and also maximally reducing taxes. Okay. Now, most of this is going to be in the sense of getting investment loans, business loans, maybe setting up a lending corporation if you're a sophisticated investor or higher, with the pretense of we're trying to build passive income that exceeds our savings, expenses, and taxes. Now, debt is something that can help accelerate that if we use it on a corporate basis. It's not consumer, it cash flows, it pays for itself, right? But also, so can tax reduction. Now, one of the caveats here is for the average person, it's easier for us to reduce their taxes than it is for us to get them debt. Okay. And the reason being is if I'm going to get debt, if I have a corporation, I'm going to need, a good amount of collateral in place, whether that be assets or cash. I need to have, a cash flowing business, meaning I actually have to have revenue that exceeds my expenses. And I need to have probably, a good 6 to 9 months of that at minimum. Right. And then I also need to have credit worthiness where I have a good payment history. The banks believe that I can pay and I can show them proof to reasonably make them think so. Right. And so it's going to take some time to build that. Whereas with taxes, we can just go in and say, okay, what are you paying now? And what are the ways that we can reduce your taxes? And there's not a whole lot of qualification that goes into it, right? So it might be easy to think, okay, well, if I'm trying to get, a home equity line of credit on my house, if I'm trying to get business lending debt, then, that's going to be more of a long road to get to. And so I should just focus on the taxes instead, right? There's some truth to that. We definitely want to reduce taxes, but here's the thing. We talked about cash flow. One of the things that a lender is always going to look at is what is this person's income, right? Now, what happens when we file a really good tax return where we do a really good job on reducing your taxable income? Well, your income went down. On paper, it shows that you make less money. Now, a lender is going to look at that and they're going to be concerned. If I'm trying to get, a first position home equity line of credit on my house, and I come to them and I say, hey, my 2 years ago on my tax return, my income showed 140, and then I worked with Wealth DynamX and now it shows 60, which is awesome because now I pay less in taxes. But a lender is going to look at that and say, hey, your income dropped from 140 to 60. That's concerning to us, and they may not give us the loan. Right. So that's what we're trying to solve for here. Now, there's a little bit of a balance and attention. And I'm actually somebody that learned this firsthand. I've always been very aggressive with my tax planning. And so because of that, on my taxes, I actually show little to no income. And so a lender's not going to touch me. They're not going to give me, a line of credit to go buy a piece of real estate. They're not going to give me a mortgage. Right. And so I don't have a lot of debt in my life, partially because I don't need it. And then another part of it is I can't qualify for something if I don't have the income. And had I known that sooner, I probably would have done a little bit better of a job, making sure I get the debt that I wanted first, doing some tax planning, but not going crazy. And then once I have the income and the debt and all of that in place, then I can go Hail Mary on the taxes and bring it all the way down to zero because I don't need to show the taxable income anymore. Now, the other thing to consider here is the cost, right? And what I mean by that is when I have debt, there's cost of interest, right? And so, if I can get a line of credit on my house and drop my mortgage payment down to 30% of what it is today, that's called a residual return, meaning I'm going to see that every single year in savings for the next 30 years of my mortgage because of something I did once. Right? On taxes, though, if I handle business for taxes this year, I only see that this year. Next year, I have to do it all over again. And then I have to do it all over again the year after that. And every year, I have to do another cycle of action on my taxes to reduce it. And that's not residual. Okay, so when we're comparing which one's better, what should I be doing first? Should I be trying to get loans? Should I be trying to get lines of credit on my home? Should I be trying to replace my mortgage? Or should I be trying to do tax planning? The answer is always, it depends. Now, no one is the same. However, I recommend that we keep your income fairly stable on your taxes until we replace your mortgage, right? Until we get all of the ducks in a row on lending. Now, later on, it's a different story, but we're talking about primarily with a mortgage right now. We're going to get that fixed first, then we're going to do the taxes. Now, once you're sophisticated and we start getting corporate debt, business debt, and investing with it, it really doesn't involve your personal income anymore. You've got the income of the corporation and the credit of the corporation. And so we can ride on the coattails of that. But for somebody that's on our blueprint to financial freedom and you've done, phase 0, you've paid off all your consumer debt, you've done phase 1, you're solvent, you're now into phase 2, you're building your reserves up. You're starting to look at things like replacing your mortgage with a line of credit. That's where we need to be able to show that your income has remained stable or increased slightly for at least 2 years in a row. And so we're going to wait till after that moment to really dive in hot and heavy with tax planning. After that's done, we can then go in and go crazy on the taxes. We can get you to, the $250,000 net worth, become a sophisticated investor, start a lending corporation, have that showing its own income. And then really, we don't need your personal income any longer. So guys, I know that that's a lot, but this is something I'm running into more and more where clients are saying, hey, I want to reduce my taxes, but I also want to replace my mortgage, right? Or I also want to get this loan, or I also want to get that loan, and realize those things do compete. If I want to get loans, I need high income. High income means high taxes. If I want low taxes, it's going to mean low income, which means I don't qualify for loans. Again, firsthand experience, I put the carriage in front of the horse because I was very, very, focused on taxes. And so that is something that in my personal credit life, I haven't really been able to get some of the mortgages, some of the different loans that I might have been able to get had I shown higher taxable income. Again, not the end of the world. I'm able to mitigate that with corporate lending in other areas, but it's definitely much easier if I can just show them a tax return that shows 2 years of stable or increasing income, get the loans, then go handle business on my taxes. Guys, that's all I have for you today. Thank you for watching. If you have comments or questions, I would love to hear from you. So if you have a question on this video, drop that in the comments. If you've run into the same problem where your taxable income was so low that you couldn't get lending, I'd love to hear about that in the comments. If you'd like to learn more about this, maybe you're approaching, do I do tax planning? Do I replace my mortgage? Do I get this loan? And you've got some questions that maybe we didn't cover in depth in this video. I'd love to hear that in the comments as well. So drop those there, and I will see you guys next time. Be sure that you like, share, subscribe, and turn notifications on. Hey, thank you for watching my video today. If you saw this and you wondered, how can Wealth Dynamics, how can Jerry Fetta help me? There are a couple of ways we can do that. Number one, we do a free financial course. We call it Finance Friday. Every single week, Friday night, 10 p.m. Eastern time. You can join that free if you click on the link in the description. Number two, if you would like a 2-week free trial to our online financial university, it's called Wealth Dynamics University. You can get access to that 2-week trial as well by clicking the link in the description. And that's going to give you access to literally hundreds of videos on finance. Third, if you have not gotten a copy of my book, Blueprint to Financial Freedom, okay, this is a book I wrote last year that goes through the exact steps that I have taken that I got from the top 1% of wealth historically by studying them that have led to me being worth over $2 million and financially free before the age of 30. And then finally, if you would like to get some help, if you're watching this and you're like, hey, I've been seeing maybe a couple of these videos. I've been following Jerry. I've been following Wealth Dynamics. I'm interested in the next step. Reach out to my team, schedule an appointment with us. We can answer all your questions and get you on your blueprint to financial freedom.